Hello everyone, Danny Sinowitz here again, the College Dude. Today we're going to be talking about the student loan interest deduction and some of the things that you need to be aware of in order to be able to claim this deduction. It's important to find out some of the specific eligibility requirements, so let's get into it. Let's cover the highlights of the student loan interest deduction. The first thing to cover is that it is a deduction, not a credit. So the difference is with a deduction, you can take this money off of your income. In other words, the interest that you pay can be taken down from your taxable income, which means that you made less, which means you should pay less in tax. A credit, meanwhile, is something that you can actually get back from the IRS on a dollar-for-dollar basis. You can deduct up to $2,500 of interest paid per year, but that number will also phase out based on your income requirements. An example would be if you paid up to $1,500 in student loan interest, you can deduct that full $1,500. If you paid $2,500 in student loan interest, again, that's the maximum that you can take. If you paid anything more, for example, $5,000, the max is $2,500 that you can write off in student loan interest. However, it is an above-the-line interest deduction, which is great because it doesn't matter whether you're taking the standard deduction or you're itemizing your deductions. You can still add this one either way. There are income eligibility requirements in order to be able to claim this. So if you're married filing jointly and your modified adjusted gross income is under $150,000, you can claim the full $2,500 benefit. But if your modified adjusted gross income is anywhere between $150,000 to $180,000, it will begin a phase out process where you're not able to claim the full deduction. If you're making more than $180,000, you're no longer eligible. You can split these numbers in half if you're either single, head of household, or qualifying widower, and that's your filing status. If you're married filing separately, you're not eligible to claim this deduction altogether. There are some taxpayer eligibility requirements as well. Specifically, you must be legally bound to actually be paying this interest. That's required. You cannot be claimable on another person's tax return in order to be claiming this interest as well. And you must have been enrolled at least part-time in school if you're claiming this deduction. Some of the things you also need to be aware of are the eligible loans. Nearly every federal direct loan that you're going to see on here is eligible, in addition to state education loans and private student loans. What you must be aware of, though, is there are certain loans that are not eligible. For example, if a parent took out a 401k loan or a 403b loan in order to pay for school, that's not eligible to be deducted in this case. The other things would be private loans through another individual or a family member, for example. It needs to be a qualifying student loan provider in order to be able to claim this interest. Lastly, the filing status is important as well. You are going to get a 1098E form from the student loan provider if you paid more than $600 in interest. You can just include that when you go to file your taxes, and that'll be able to tell you how much you can deduct. However, if you paid under $600 in interest, it doesn't necessarily mean that the provider is automatically going to send you that form. It's worth calling them if you know that you've been paying a student loan and you've been paying interest that year in order to make sure that you get your 1098E form that you can file. The IRS is not allowed double dipping, and what that means is that you cannot be claiming multiple credits or multiple deductions for the same dollars that you've been paying. So for example, if I paid on my 529 plan, if I paid schooling from a 529 plan, and then I later wanted to claim that same dollars from the same funds from the American Opportunity Tax Credit, that would be a violation as far as the IRS is concerned. So you have to make sure that the funds that you're actually deducting here on the private loan haven't been paid in any other way by any other type of credit or deduction. And lastly, the funds that were accrued from the private loan must have come from a qualified education expense. You can see the examples down here. And the IRS gives you a general idea of what those qualifying education expenses are. You have it, the student loan interest deduction. As always, make sure you talk this over with your CPA or accountant before you go ahead and take advantage of this deduction. It is important that you make sure that this is right for your specific situation. That being said, what you also must remember is that you can be eligible whether you're a student borrower or a parent borrower. You just need to make sure that you talk this over with your CPA or accountant. As always, I hope this was helpful, and feel free to check out my page for more tax tips when it comes to college savings.